In the last month and a half, Alibaba's stock price has sank by almost 30%. And this is despite talks of continued stimulus being rolled out throughout China. However, these stimulus really don't mean much if they don't have an impact on businesses' top and bottom lines throughout the country. So today we are going to take a look at Alibaba's earnings as well as a few other companies throughout the country and what results they are putting up and how that reflects on the Chinese economy as a whole. I want to say thank you guys so much again for the support. The channel in the last month has been growing at a very fast pace, and that is due to all of you guys tuning in, watching the videos, hitting the subscribe button, as well as dropping likes down below. It means so much to me. Thank you guys, and if you haven't yet subscribed, make sure to hit that subscribe button down below. Before we jump into Alibaba, let's take a look at the YouTube portfolio. Currently, it's sitting at a value of $57,963.26. It's up almost 8% in the last month, increasing by $4,000. In full disclosure, before we talk about Alibaba, I do own shares of this company within my YouTube portfolio as well as my main portfolio. Here I have 15 shares. The cost basis is currently just under $1,200 with a market value of just over $1,200, which puts me up around 7.5% on this position. Google is my only position in the red, down around 2.5%. Apple currently up quite a bit, 370%. I was buying the stock back in 2018. I also own Microsoft, Palantir, PayPal, SoFi, and Visa, with a total return of this portfolio of around 150%. I also own two dividend ETFs within this portfolio, SCHD and VYM, which combined have returned around 23%, and I do have quite a bit of cash sitting at $12,644.01. So right now, my cost basis on my shares is somewhere in that $70 to $80 range, and it looks like Alibaba could be headed back there. We saw a huge run up in the stock at the end of September with stimulus being announced throughout the country. However, since then, the stock has fallen again by around 30% and appears to be headed back to the $70 range. With this dramatic decline in the stock price, it is now only up 11% year to date. And over the course of the last 5 years, it has fallen by 55%. From its all-time highs of around $310, the stock is now down 73%. One of the reasons that Alibaba's stock price has suffered so much in the last couple of years has been the stance that China has taken on large tech companies. And this has affected the broader economy throughout the country. They took a stance of trying to mitigate the hold that these large tech companies had on the country and its economy. One of the ways they did this was by fining a lot of these large tech companies and trying to make them less of monopolies. However, this has had a negative impact on the Chinese economy, and since then they have looked for ways to try and reverse this in a very slow manner. One of the most recent ways is they have actually created an AI advisory body within China, and one of the members of this board is actually a founding member of Alibaba Cloud. Obviously, this isn't a huge step in the right direction, but it is a small step, and I think that speaks a lot to China and how they're going to address a lot of these larger tech companies within the country in the future. We know that in the past, they have had strained relationships, especially with Alibaba and Jack Ma, and that appears to be turning around with some of these adjustments that they're making. And even Alibaba is making adjustments to try and better position themselves within China as well as within the world. They have announced that they are going to merge their global and domestic e-commerce businesses. Personally, I think that this is probably a good move. It sounds like it's primarily focused on trying to get the right leadership people into the right positions to make decisions quickly that will have business impacts. Alibaba's been a company that has shifted around a couple of different times. 20 months ago or so, they actually announced that they were going to divide the company into 6 separate units. That never ended up coming to fruition, and since then they've kind of made a few different adjustments. I am glad that they are a company that is not scared of making these changes and announcing them and trying them out to see what works. I think overall that's what good companies do. They try different things, see what works, see what doesn't work, and then make adjustments from there. But ultimately, we need to see some of these adjustments that China as well as Alibaba are making actually affecting companies' earnings. Alibaba announced their earnings back on November 15th, and they reported EPS of $2.08 compared to $2.04, which were expected. So that was about a 2% beat. They missed, however, on revenue by about 1.5%, coming through with $33.7 billion of revenue. Revenue revenue of $33.7 billion represents an increase of about 5% year over year, while their EPS number of around $2.08 represents a decrease of about 4%. This slow top-line growth for Alibaba has been a major problem over the last couple of years. They saw a peak trailing 12-month revenue of $134.5 billion achieved back in March of 2022. The following year, they actually saw their revenue decrease by about 8% year over year, and they have since seen it increase slightly, and they're sitting at that low single-digit revenue growth year over year. They are trying to fix this by focusing a lot on some of their potential higher growth areas, one of those being their cloud group. It only grew by 7% this quarter. However, their public cloud growth grew by double digits, and their AI-related products grew by triple digits this year. But you have to keep in mind that this is not just an Alibaba problem. This is a problem throughout China. Baidu is another Chinese company. Their stock in the last month and a half has also fallen by around 30%. Baidu has had a rough earnings season. They reported back on November 21st, and they missed on both their bottom line numbers and their top line numbers. And their top line has also seen a slight decline over the last 2 years. They peaked at a revenue again back in March of 2022 of $19.7 billion. It has since fallen down to $18.7 billion. Pinduoduo is another Chinese company. However, this one people feel like has taken a lot of market share away from companies like Alibaba, especially with their Temu product that has been favorable in the US. However, Pinduoduo is still down in the last month and a half around 35%. And they also came through and missed on both their top and bottom line numbers. But the story for them is a little bit different. It is a slowing of growth by a significant amount. This has been a company that has grown very quickly. At one point in the last couple of quarters, they were growing by 130% on their top line. However, that has since fallen down to 44% growth in their most recent quarter, which is the lowest growth they have seen since 2022. So again, this is not just an Alibaba problem. This is a China problem as a whole. We are seeing this across the board for these Chinese companies, whether it is a significant slowing down of top line growth or just flat growth over the last couple of years. And there isn't a clear line of sight as to when this problem will eventually go away. Right now, they're targeting 5% GDP growth in 2024. It sounds like they're going to target somewhere around 4.5% to 5% in 2025, which is decent. However, it is quite a bit lower than what we were seeing prior to 2019, where they were growing anywhere from 6 to 8% year over year. And this growth could become more difficult with Trump coming into office, as he's talked about potentially increasing tariffs up to 60% on Chinese imports. However, back in 2018, when Trump first imposed tariffs on China, we still have continued to see actually growth in their investment as well as manufacturing regions within China. The biggest problem though coming out of China is this graph here. Their consumption makes up only 13% of global consumption, as opposed to their investment and manufacturing making up over 25% of global manufacturing and global investments. They really need to start seeing the Chinese consumption going up in a major way. If they see that, they can actually produce goods domestically and sell them domestically instead of exporting them out of the country. That would help create a more stable economy within the country, as well as potentially impact a lot of these companies' EPS numbers. They had a peak EPS for the trailing 12-month period of $9.37 back in 2019. Since then, Alibaba's EPS numbers have declined all the way down to $3.86 for the trailing 12-month period. And a decline in EPS is despite the fact that they have repurchased a large number of their shares in the last couple of years. In total, in this most recent quarter, they actually repurchased $4.1 billion worth of shares. As of last quarter, their year-over-year decrease in shares outstanding was almost 5%. And we've seen that actually as a consistent trend over the last couple of years, where they have consistently decreased their shares outstanding by anywhere from 2.5% to 5%. The most attractive thing about China right now is the valuations of the companies within the country. Right now, Alibaba is sitting at a forward P ratio of 9.49. When we think about the S&P 500 and the fact that it's trading around a 24 PE ratio, that means that Alibaba could double and it would still be trading below the S&P 500. And that just speaks volumes about the valuations in the US compared to China. So for me personally, I'm going to be paying attention to Alibaba over the next couple of months. If it falls back into that range of $75 to maybe even $70, I might look to add a little bit to my position. However, I have built them out over the last couple of years as it's been in that range anyways, so I'm comfortable with where my cost basis is at right now. But keep in mind, do not buy a company just because some random guy on YouTube talked about it. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. I hope you enjoyed the video. If you did, drop a like down below. And if you want to see more videos like this one, subscribe. And as always, guys, have a wonderful rest of your day. And for the joke of the day, why didn't the chef season the turkey? Check the comments down below for the answer. Thanks for watching.